Thank you. Tonight's report begins with the 4th of July parade at Fairmont.
No, we're on D1.
You're on D1.
Yeah. But we'll get to you.
We'll get to you.
E1.
Sorry, Dr.
That's okay. This will be equally.
Yes.
This will be equally exciting. Mr. Olson, not quite the 4th of July, but we're glad that you're here anyway. And I've got a.
Nope, thank you very much, Madam President, members of the board, Dr. Harder. I'm here tonight. I'm Dave Olson with KNN Public Finance, and I'm here tonight to talk about the district's assessed values, which were released just last week. It seems like we've been talking about them forever, but the new assessed values for 2013-14 were released last week. The news countywide was very good. Assessed values grew by almost 3.5%. Growth was particularly strong in some of the East County cities, 6, 7, 8% growth that had been hit the hardest during the recession. The increase comes after a number of years of negative growth, and according to the report, it's about AVs are still 7% below their max. But in general, it was a good report countywide. We haven't had growth in a long time. Just about every city was growing. Unfortunately, the news wasn't as good for this district.
What else?
Assessed values were down by almost 6% in the district, which brought us back to period of negative growth that we experienced a few years ago and we seem to be coming out of. The decrease was largely driven, I'll talk about that on the next slide, by a significant decrease in the city of Richmond. And that, according to news reports, is largely due to the refinery fire at Chevron. I'll talk about that in a little bit. But based on those figures, to kind of put it in context, the county is about 7% down from their highs. We are 17% down from our highs. And since we build these programs around the idea of growth, that the effective decline is almost 33%. So here are the city-by-city results that I was talking about. El Cerrito, Hercules, Pinole, San Pablo, all like the rest of the county. Pretty good growth, 3, 4, 5%. Richmond, as you see, down by almost $2 billion. I think I saw something that it was over $1 billion it was the loss in Chevron. So there were some other losses in Richmond, but Chevron was the bulk of that. And we expect to see the district tax base down at $22.2 billion. So it's significantly bad news. We were very disappointed, but we do see some silver linings. The best news is that assessed values are moving up generally, and except for the Richmond fire, they would be moving up in this district too. We also see the reports of property values going up, and so we'd expect 2014-15 to be a good year. The Richmond event, as we're learning about it, we need to learn more about that. I think that's another thing we want to mention. This is we've been talking about more communication, more transparency with the county assessor. This is another opportunity to kind of push on that, and we get some value from it. Because it appears to us that this is a one-time event that should reverse itself pretty quickly, perhaps even by next year. We don't know that, and I don't know about enough about the assessment process to learn. I know the city is very interested in hearing from Mr. Kramer's office, and I think we should be too. Another piece of good news is that we've been planning for kind of the unexpected events like this. So we've been collecting some tax rate stabilization funds. I think we have, maybe I talk more specifically on a future slide, have collected like $11 million So we're in good shape, tax rates, with all the prior elections. That's good news. We had built a bond program that, through the mid part of the 2000s, we got faster and faster. When we got the bad news in 2008, had us scrambling. We've built a program that's more sustainable. That's more good news. I don't think we're going to have to affect the size of the 2013 sale. We have a few years to respond to this piece of bad news, which, again, may reverse itself by the time we need to respond. And I think it's good news that you've already begun kind of reaching out to the assessor's office on this. So let's look at the 2013-14 tax rates. We've had, as you know, had a long history of meeting the tax rate targets. We want to, voters have been good to us. We want to be good to the voters and taxpayers. And it appears that we'll be able to do that. Here's where I mentioned on the slide, $11.6 million has been collected in tax rate stabilization funds for this very reason. We may have to draw on that a little bit this year, maybe $3 or $4 million. Figures that I'm going to show you coming up are pretty conservatively based. They show about $3.8 million of a draw. And but the thing to point out here is that that's a faster draw than we've been counting on. And so either this is going to reverse itself pretty quickly and we're going to get strong, robust growth to be out of here, or we're going to be looking at other options pretty seriously in order to keep our commitments as we move through the future. And, one place where there's a significant amount of money is the 2012 Measure E bond proceeds, that we allowed some of those funds to be spent on tax rate stabilization. That's a choice that the district's going to have to make when we get there. We probably have several years to see whether we need to do that, but I want to bring that up because that's something to keep in mind and plan for.
Well, but what I want to say is at least the board has the flexibility because they went to the voters and asked them, so that's a good thing. And
we were clear, had to add some clear language talking about the ability to do that, so that's a positive too. Flexibility, I talk a lot about. This is why we needed flexibility, and because of the flexibility, we have a couple of years to figure out what we're doing. I think that's very good news. These next slide go through measure by measure just to show the figures and what we're doing here. 1998, it's going to conclude with a recommendation, and we're going to bring a resolution to the board in 2 weeks. But 1998 Measure E is the small $40 million program. It's a program we haven't had any issues with the tax rates on, and the tax rate for that ought to be around $13 next year, probably be significantly less. As I said, this is a pretty conservatively built model. But the max target was $26. So that easily makes our target. Measure M, in order to make the target, and you'll see on this fourth line down, 1, 2, 3, 4, the fifth line down, that we're going to have to use some of the tax rate stabilization funds in order to meet the tax rate target. But we have $3 million set aside. We're going to use the first couple $100,000. But we should be able to meet our 55-60 tax rate target there. That's not a Prop 39 bond. Let me mention before I leave the 2000 Measure M. 2000 Measure M is one that we thought was, we were growing less concerned about. We thought the likelihood was that we'd be able to make tax rate commitments, have tax rate stabilization funds to spare. That's back on our radar as something to be concerned about. 2002 Measure D, that has, in the short run, that is the most constrained of the programs. We're going to spend $1 million or $1.5 million to $2 million of tax rate stabilization fund. That gets about halfway through the amount that we've already set aside. So that's, in the short run, is one that we're concerned about. But 13-14, we're going to make it. 2005 Measure J, that over the long run is the biggest concern, but in the short run, we have $5 million set aside. We have to spend somewhere between, $1.25 million and $1.75 million, bringing that in line. But we're going to make it on 2005 Measure J. 2010 Measure D and 2012 Measure E, the two newer programs, we have a different issue with, and that issue is that the tax rates would be, we need to set tax rate based on this 2013 issue that we're planning on bringing to market. So those with the new issue will be up at the $48 target, Measure D and Measure E. And so what things will look like in 2013-14 based on this recommendation is that we let the 98 Measure E tax rate be whatever the county calculates it needs to be, and that we set at the max for the 2000 Measure M, 2002 Measure D, 2005 Measure J. Those will also require a draw on the tax rate stabilization funds, and that we set at what voters approved as the target maximum for the 2010 Measure D and 2012 Measure E. So what that would show, and you remember last year we brought the tax rates down on Measure D in order to provide some relief in what continued to be a difficult time. The tax rate will be higher in 13-14, and we're projecting here $285, a little bit more than that, versus $215 last year per 100,000. But it will be, it will be below what the target maximum has been for the program and what voters have approved. So we continue to be able to make our targets, though there will be, if tax rates are set as we recommend here, it will be higher than last year. So there'll be an increase there. The next steps, we presented this to the facilities subcommittee yesterday, heard some good comment. We're presenting the same, essentially the same material here. Want to hear the inputs, particularly on the last page, these 13-14 tax rates. Why we recommend levying at the maximum for 2010 Measure D and 2012 Measure E is we want to start getting those paid off. So there's more bonding capacity in the future, more tax rate capacity. And then we'll put together a resolution. I think a draft has already been going around for your approval on July 24th, requesting that the county set tax rates at that levy, at that level. We've already met with people in the Auditor Controller's office. They're very supportive of the program. They like the idea that we're proactive. They thank us for coming in. They tell us we're the only district that comes in and pays attention to it. So that's been a very good experience. And the proposed rates, they'll be developing them and having them approved by the Board of Supervisors in September. So that's it on 13-14. The bottom line is we got bad news, unexpected bad news. Remember, a month or two ago we were talking about, hey, what kind of increase are we going to get? We got negative 6%. Unexpected bad news. The good news is we've been planning, we've been building a program so it's a little bit more flexible. So this year, tax rates will be within the targeted maximums. We look good for next year as well, but we ought to be thinking about the future. That's the hard decisions still need to be made, but they don't need to be made in crisis mode. Moving forward, I think there are a number of questions to ask, given that this is a very serious decline. Most of them have to do with the assessor and how quickly we're going to be back up. So how much of this decrease is specific to Chevron? We've already started to see some figures on that. How quickly will it get back to those levels? What about other properties? How quickly are the Prop 8s going to be back? How much of the Prop 8s have been coming back? So are we going to get this kind of robust growth that's going to put us in the clear, or should we plan on continued slow growth after this? And how will communication work going forward? Will we be able to hear? I think we talk about a July surprise. This July surprise, it was a bad one. The last July surprise was a very good one, but we had just issued some bonds, so we would have liked to have known that a little bit in advance. This is something that the assessor, this decline is something that the assessor probably had some sort of an idea on in February and March. And we didn't know what it was. Let's not have any more July surprises. And what other resources are available? If we are not expecting a fast decline, we need to think about that 2012 Measure E. What's the what priority is keeping the tax rate commitments versus the priority of making sure those money gets spent on facilities, what's the right balance for the district. So that'll play itself out over the course of the next year. Accessing new money bonds, like I say, we're very pleased to be in the situation we're in, where we had early on in the program, in a flexible program, we've been talking about having a new issue somewhere in the $100 million, $125 million size for 2013. There's no reason to change that now. What it means is 15, 17, 19 are the ones that may have to be impacted. We talked a lot about, hey, can we accelerate? That's a little bit on the back burner, but let's see how it plays out over the next couple of years, particularly how quickly the assessor thinks we're going to come out of that. So we think the discussions need to be kind of parallel. What's going on with AVs in regard to the Chevron Chevron fire, and how are we adjusting our program. But we don't have to make any final decisions on the program until we get the outcome of the AV discussion. So with that, I'll answer any questions you have and look for comment on the 2013-14 tax rates.
Do we have any public speakers?
No.
No. Okay. Mr. Ramsey.
Yeah, what I had asked yesterday, it was a good presentation, so I don't think we're kind of in a wait and see, especially since we're going to be looking. We have Sean here, as a matter of fact, we're going to go back into closed session. But so we still think there's a question mark around AVs in terms of what happens with the city of Richmond. But we talked about 40-year currents, and I thought you'd have a slide on that. I don't see anything about differentials. We had asked yesterday what that would look like.
I think I do, and I think I just failed to hit it in terms of accessing the new bonds. The fourth bullet there says,
What page are you on? I didn't see that.
slide 15, in order to increase future flexibility, the district might want to consider minor structuring changes to the Series 2013 bonds, including extending the term for the Series 2013 bonds beyond 30 years. That's a good point. I should have hit it here in the,
well, let's
in the
talk
discussion.
about it. Let's talk about what is it.
The advantage is if the bond programs are built around a projected revenue stream, in general, I would argue a couple things on that, but in general, built around a future revenue stream. If that revenue stream is coming down, get more ability to hit or accessing new proceeds by pushing some payments out. We're not talking at this point about using, a significant number of cabs. That's the situation we were in the old program. With all current interest bonds, but pushing out a little bit. 40-year bonds are currently, the law states that 40 years is the maximum term. We've been running our program around 30 years. But and AB 182 is being considered now. What it looks like is they'll allow the 40 years for another 5 years and then bring it back to 30. So if we're thinking that longer term is going to be good in the future, 15, 17, 19, 21, we might want to start doing it a little bit now.
I really want to recommend
that's a flexibility argument rather than a
right. I think it's important to not stop the program because we have a county assessor who we don't know what's going to happen with. I mean, we just don't know. And so, for me, I think the voters have no problem with currents. They're not capital appreciation bonds. And they're still below the ratio. You said 3-to-1, right?
The ratio is likely to be well below 3-to-1 on a current interest bond in the current market.
That's just a win-win.
Even at 40 years.
Even at 40 years. So, and with what we're getting, not having the impacts of this Chevron thing or whatever else we're talking about, at least it gives us the ability to not worry so much about, we have to build Pinot Valley High. And that's the big one coming up in 15 and 17. So we've gotten Portal out of the way, we've gotten El Cerrito High, we've gotten Deanne's out of the way, but that's really, if you look at the major that's a major project that needs to happen. And you need that flexibility. And if 2013 we're at least giving them, we know we'll be able to issue in 2015, get their state eligibility money of $12 million, might even be more than that. They get the seismic money. it could be even bigger, 30 or 40 more million dollars. That means that project is well worth preserving and doing. And then you would have basically done work at almost all your high schools. So I just think it's an opportunity. Sherry, if we can look at some resolutions looking at that.
What we'd like to do tonight is also get board direction on preparing the resolution that I can send over to the county, so that we're going to try to take a more formalized approach this year. Last year, we brought this information to the board, and what we did is we wrote a letter and based upon board direction. But this time what we want to do is create a resolution that we'll be bringing back to you on July 24th, so I've got to get that turned in on tomorrow. So I want to make sure I get board direction on that. And then what we'll be doing is bringing back a finance plan to move forward into the late summer, early fall. We'll be beginning to create our POS and all of the documentation, legal documentation that's necessary for the board, and that'll include the financial plan. And our whole team will be here for that discussion.
Yeah, and so I have no problem with the tax rate collection schedule that you proposed for this year. I'm fine with it. It's underneath the targets. It's what everybody says. We gave a tax break last year when we went down from 48 to 31 on Measure D, but voters have said they've approved 48, 48, 60, 60, 55, and it's up to 20, so I'm fine with that.
Yeah, again, higher than last year, but within the targets that the voters voted on at each of those elections.
So I don't know what the rest of these asking, Sherry's asking if you guys are okay with it.
Yes, you can.
Yeah, I don't have a problem with it. I mean, that's what the voters approved. They said $48 per 100,000. That's what they voted for. 64% of the people said they'll pay it. All right. So that's fine. I think you got consensus for that. But I do, like you said, start to look at some structuring around 40-year SIBs, current interest bonds, and look at what that looks like.
Okay. Thank you very much.
Any other board comment? Nope. Mr. Groves? No. Okay.